Hey everybody, it's Larry Berman here. This is the last recording of the year on my YouTube channel here. It is the last Berman's Call episode on Monday, and in the last one of the year, it's always about my fearless forecast. I've got my ugly Christmas sweater on. I've got my putter ready to go. I'm heading out to the golf course, and I'm growing my Santa Claus beard, as you could see here, which I sometimes do this time of year. And let's have a look at the chart room and see what's been naughty and what's been nice. We've said now for a couple of years the long end of the bond market is going to be a challenge. We've had a couple of big rallies in 2023 towards the end of the year. We had a big rally this year into Q3, but where we end up now, you could see TLT around 90 compared to where we were at the beginning of the year, 99. The long end of the bond markets had a terrible year. And so this year, if you look at the total return of the US bond market, a little bit better in Canada because the Canadian economy's significantly weaker than in the US. Our bond market's done a little bit better, but that's certainly nothing for Canadians to cheer about from that perspective because our equity markets have underperformed the US. The credit markets are going to be a challenge. The duration markets are going to be a challenge. Credit right now, because equities have done so well, is so tight. And so, what's been bad and what's likely to continue to be bad is fixed income. And you really, really need to think outside the box in terms of how do you deliver a safe, real return on your, safe fixed income money. And I've been saying for a number of years now, traditional bond markets are broken. It's not the way to go. You need to look at private credit. And so on the, what's in the good side is private credit. The Q Wealth Private Credit Fund this year is going to deliver another year of about 7.75%, which has been pretty steady Eddie, consistent for the last 4 years now, while the bond market and the public bond markets have been an absolute unmitigated disaster for 4 years running now. From a real return perspective, as in getting more than the rate of inflation, and in many cases actually getting a positive return. So that's a bit of what we don't like in Santa's bag. The other thing that's not going to be in the stocking stuffer this year is a lot of rate cuts going forward. Fed meets this week. Markets pricing in virtual certainty, not complete certainty, that they will cut 25 basis points. But as we look at the summary of economic projections and the dot plots going forward, in order to get a real hawkish move, you have to get most of these central bankers thinking that they're not going to do anything or very, very little compared to the last meeting. Right now, the market has two more rate cuts priced in for all of next year if they do 25 next week. And to me, that's going to be at some point very disappointing to equity markets, along with the very persistent higher for longer term interest rates. So as long as the US economy continues to fire, we're looking at a 3% quarter in Q4 right now, and earnings keep delivering, then markets are going to be okay. And so, on the economic front, inflation, PPI, core starting to tick higher again. Again, equity markets don't care right now because everything's AI. Broadcom just had a great number. And oh my God, isn't that a great thing in your stocking stuffer if you had some of that today up 25%. But the coal, or the canary in the coal mine, is the massive amount of debt. And every other day, Trump is tweeting something about a different type of tax cut. And boy, Doge ain't going to be able to pay for that all. So it's going to be interesting. When we look at other parts, we saw a significant uptick this week in initial jobless claims. Those aren't unusual. They happen from time to time. We saw a spike a few months ago in and around some of the hurricanes, a little bit in here, but none of it, a year ago, none of it ever really manifested into anything permanent. It was a spike for a couple of months and it came down. So if we start to see this again, like we did seasonally at the end of December in 22, in 23, what is this? This is companies finishing the year, starting to clean house, laying some people off. We're likely going to see that. That, to me, keeps the Fed on in terms of wanting to cut rates. So we're almost certainly going to get a rate cut this week. But really on a look-forward basis, this needs to be persistent for more than just a month or two in terms of breaking the back of the equity market. So 242 right now is the number. Again, we just get concerned about it. So seasonally adjusted, non-seasonally adjusted, there's a seasonal pattern. You can see it over and over and over again. But it's this seasonally adjusted number that really is the weekly reported number. So we'll have to see how that plays out. If the labor market breaks, the Fed will need to do more than 2 rate cuts, and that's going to put a lump of coal in the equity stocking. So the reason equities are so vulnerable is if we do get continued economic strength, S&P 500, earnings after Q1 reports in January and early February, 242. Actually, if you turn back the clock a year ago, the street was expecting 233. So we outperformed in terms of earnings growth, but the vast majority this year was a huge multiple expansion. So on a trailing basis, we're 25. On a forward basis, we're 25. The forward basis a year plus, we're 22, which is very expensive. 2 years plus, 19, 20, very expensive. With huge expectations for earnings growth over the next couple of years. So again, equity markets have priced in perfection, Goldilocks. When we look more at the real economy, not the mega cap tech names, but the small cap S&P 600, markets are priced on the small cap side, looking forward, much, much better. So, our favorite trade probably, say probably because it's never certainly, for 2025 is to rotate some of that money out of the more expensive large cap into small and mid cap stocks. And that's a trade we'll be putting in everybody's stocking stuffer for Q Wealth as we get to the end of the year. Anyways, I'm heading out to the golf course. Have a great holiday season, whatever you celebrate this time of year. Make sure you party on with your ugly Christmas sweaters, and we'll see you in the new year.